Hi, everyone. Thank you for joining today's webinar. We will be starting in just a few moments. All right, everyone. Thank you so much for joining today and welcome to our webinar titled The Election is Over. What does this mean for my taxes? Before we dive in, I do want to cover a few housekeeping items to ensure that you get the most out of today's experience. First, all participants are currently muted to minimize background noise. However, we do encourage you engage with us throughout the presentation. So if you have any questions or comments, please feel free to type them into the chat box at any time. For those of you seeking CPE credit, it's important to note that you will need to answer all 4 poll questions that will pop up during the webinar. Your participation in these polls is essential for receiving credit, so please keep an eye out for them. Lastly, I want to let you know that this session is being recorded. We will send out a link to the recording within 1 to 2 days after the webinar wraps up, so you can revisit any part of the presentation. Now that we've covered those details, I will turn it over to today's presenters and have them introduce themselves. Jake and Jared, take it away.
Okay, thanks, Jamie. Appreciate that, and welcome everybody to today's webinar and everybody's favorite topic, taxes, right? So hopefully Jake and I will share something with you today that will be meaningful and helpful to you in the coming year. The only thing I think I wanted to point out on this slide is that Jake and I probably both need to update our photos. We look a little young and there's not enough gray in our hair, so we'll have to work on that. But yes, Jake and I will be presenting today. I am Jared Frost, and I am the partner in charge of our mortgage banking tax practice here at Richey May. Been with the firm about 15 years now, so getting to be one of the old timers here at the firm, and it's been a fun ride to explore the mortgage banking industry here with the firm. Jake, why don't you go ahead and introduce yourself?
Sure, thanks, Jared. As Jared said, I'm Jake Lawrence. I'm a tax partner here at Richey May in the mortgage banking tax practice, and I've been with Richey May, just hit my 12-year mark here in January. And so I've enjoyed, as Jared said, I've enjoyed learning all things mortgage banking and helping in the industry however I can. So look forward to today's opportunity to talk to you about, as Jared said, our favorite topic, tax. So
great. Great, thanks, Jake. All right, most of you probably know us pretty well, but those who might not, this is just a little bit about the firm. Richey May has been around about 40 years now, and has started out pretty small, but sort of got a couple of clients in the mortgage banking industry pretty early on in its existence, and has grown that, and now mortgage banking is certainly one of our primary niche focuses at the firm, and have dedicated teams to focusing in on all things mortgage banking. So in addition to our typical audit and tax practices, we also have a business advisory services group, and so really been able to expand our service offerings over the years and really focus on needs of mortgage bankers across the country. A little bit about today's agenda. Obviously, again, we're going to talk about taxes, and now that the election is over and President Trump was inaugurated a couple days ago, and so it's official, he is our president once again, and so we really wanted to kind of focus in on, now that this change has occurred, what do we sort of expect from a tax legislation perspective? So the opening line there, President Trump tax legislation, what's coming? Unfortunately, the short answer is we don't know, but there's certainly been lots of things talked about, and that's kind of what our focus will be today is what are those things that have gotten attention during the campaign and here recently as he's gone through the transition and been inaugurated. And we'll highlight those provisions that we think will be most impactful to this audience, again being our mortgage banking clients. So, but there's lots of things that could obviously impact it, market conditions, trends, and so we'll try and touch on some of those things as we go through the presentation as well. And with that, we are going to launch our first and perhaps most important poll question. So Jamie, you can launch that.
Perfect. It is launched, Jared.
Awesome. So again, if you want your CPE, please make sure that you answer all of these questions. There's no wrong or right answers, but we do need a response from you.
All right, we got about 75% in. Like Jared mentioned, get that CPE credit. We'll just wait a few more moments here.
Correct. I was thinking, Jamie, that maybe we should have had a fifth response for who cares, just for all those people who are not a fan of any of these teams.
I was gonna say, my Packers are gone. But perfect, Jared. I will go ahead and close out this poll. And the results are in. Looks like the Kansas City Chiefs are taking it by 57%.
Wow. Okay, everybody's expecting a three-peat. Well, we'll see if that happens or not. But certainly it'll be an interesting couple of weekends here as we get ready for the Super Bowl. All right. So as I was mentioning, wanted to really just touch on what I'm calling here post-election tax considerations. And so what I'm going to do is pop up here a couple of slides that really highlight some of the key things that either President Trump or the Republicans have sort of been talking about when it comes to tax legislation, some of their ideas. I think what's important to note is that it's very unlikely that all of these things will actually become law at some point. The process to get all of this into some sort of tax legislation bill is very complex and cumbersome, and there's lots of competing priorities, and so very unlikely that all of this will come to fruition. But again, I think it's helpful to sort of understand what are the big wigs in Washington talking about when it comes to tax legislation. So as I pull up this first slide, I'll just kind of walk through some of these. So one of the big things, and probably one of the things that's gotten the most attention, is President Trump wanting to make all of the individual tax provisions that were part of the original TCJA, which is the Tax Cuts and Jobs Act, permanent, except for the SALT cap. So the SALT cap was one of the provisions that was in the TCJA and is set to expire at the end of this year, and he would like to just see that expire, go back to giving taxpayers the opportunity to deduct all of their state and local taxes on Schedule A of their personal returns. But some of the other expiring provisions include individual tax rates. So brought that highest tax rate down from 39.6% to 37%, increased the standard deduction, almost basically doubled it. Personal exemptions went away. Child tax credit essentially doubled. You had limitations on itemized deductions, so basically down to the big three of taxes, certain interest, expense, and charitable contributions. Made changes to AMT, including the annual exclusion amount, meaning that very few people were actually in a position where they were paying AMT. Again, that stands for the alternative minimum tax. The qualified business income deduction, or QBI deduction, that's certainly a big one, and is scheduled to phase out here at the end of the year. You got your non-corporate excess business loss limitation, so limitation on losses that from trade or business income. And so those are the individual provisions that are expiring that President Trump would like to make permanent. On top of that, as I mentioned, he would like to eliminate the SALT cap, allowing individuals to deduct all of their state and local taxes. And then he had a couple of interesting ideas, and not sure that these will actually ever make it into a bill, but talked about exempting tips and overtime pay and Social Security benefits from income tax. Also talked about creating an itemized deduction for auto loan interest, and creating tax incentive for first-time home buyers. That might be of interest to this audience. So used to be a first-time home buyer credit. Does that get reinstated? Is there some other new program that they consider? Does that eventually make it into a bill? And then also making the TCJA estate tax changes permanent. So the higher lifetime exclusion amounts to avoid estate tax, those kind of things. So Jake, as we sort of look at this list, what are maybe the one or two things that kind of stand out to you that might be most relevant to our audience today?
Yeah, great question, Jared. As I was thinking about this list that you were working through, a couple that jump out to me here are certainly the qualified business income deduction. If that were to fall off or sort of disappear, I think that could certainly impact owners of the mortgage companies in an impactful way. And the other one that popped out to me was the excess business loss limitation, and certainly what impact or changes that might have for taxpayers. Knowing where the industry has been the last couple of years, and that losses may have accumulated that and how that will impact those individuals. So those are the two that jumped out to me that I thought, certainly we'll spend some more time on later in the presentation, but I think maybe impactful to our mortgage owners. Yeah,
that's great, Jake. I agree. I think those are certainly relevant to our mortgage bankers and their owners. The other one that stands out to me is the elimination of the SALT cap, right? I mean, that's been talked about ever since that provision came into play. There's been several attempts to try and increase that cap from $10,000 to $70,000 or $80,000. Again, a pretty low threshold for some of these wealthy individuals. So where that goes remains to be seen, but it'll be interesting to see kind of if they're able to get that eliminated. Then if we flip over here to some more of the business type provisions. So you've got, wants to restore some of the TCJA business tax provisions, including bonus depreciation and small business expensing under Section 179. The interest expense limitation rules, as well as R&D or R&E, as it's sometimes referred to, research and experimentation or research and development expensing. So we'll get into some of those provisions a little bit more here later. He also talked about further reducing the corporate tax rate, and so we'll talk a little bit more about that, and also eliminating the benefits of the Inflation Reduction Act. So a lot of them are some of these green energy initiatives, the electric vehicle tax credit, so as well as IRS funding. And as part of the slew of orders or whatever that President Trump signed, the executive orders that he signed during the inauguration or just shortly after the inauguration, one of them was actually to put a freeze on IRS hiring. So we'll kind of see what his plans are as far as what he would like to do with some of this IRS funding that came out of a couple of recent bills. Already putting that executive order in place to freeze any additional hiring by the IRS at this point. And then I have imposed tariffs here at the bottom. I mean, that's obviously not tax legislation, but that's one of the primary way that President Trump is hoping to pay for a lot of these tax benefits is by imposing tariffs. And if you read commentators on that, seems like that isn't going to cover the full bill. So we'll kind of see where that goes if they're able to get some of those tariffs in place, and how does it impact what they might do from a tax legislation perspective. But so again, Jake, looking at this list, what do you think is most relevant here?
Yeah, Jared, it's again a good question. I think thinking about sort of our clients and those participating on this webinar, I would think that those three sort of business tax provisions mentioned, bonus depreciation, that interest expense limitation, certainly the R&D or R&E expensing would be most impactful for the businesses being run, both positive and negative, depending on which direction these go. If they are made permanent, if they're not made permanent, and they fall away. So again, I think things to consider as we talk about today on the webinar of how this might impact mortgage companies kind of moving forward. But those are the three that jump out to me.
Yeah, no, I completely agree. I think those will definitely be impactful to our clients. And in addition to that corporate tax rate, where does that go? Talk of it moving maybe down to 20%, maybe 15% for certain industries. So could certainly influence some decisions around entity structuring and things like that. We'll get more into that here in a little bit. All right, so with that, let's dive into some of these provisions in a little bit more detail, just to make you aware of sort of where we stand currently and what may or may not happen. So qualified business income QBI deduction, I think most of you are probably pretty familiar with this provision. If you are a qualified business under the rules, which again, most if not all mortgage bankers are, and if you have qualified business income, which again, most mortgage bankers do, then individuals, so again, the owners of these pass-through mortgage banks are able to deduct up to 20% of their QBI or qualified business income. And so, this is a pretty significant deduction for, individual taxpayers, and really mitigates against, the effect of reducing that corporate tax rate. And one of the primary reasons why they put this in place was to do just that. So, I know for our clients, 2018, 19, 20, 21 were pretty good years, really benefited from this deduction. Obviously, the last 2 or 3 years have been a little bit more challenging, and so we did want to highlight here that those QBI losses that you may have sustained in the last couple of years, they do carry forward, and they would offset any QBI income that you might have this year and future years, and so it can certainly mitigate or reduce the full benefit there. And again, this provision is set to expire at the end of this year. So unless Congress does something, which again, I think everybody is expecting some piece of tax legislation to come out here in 25. But if they don't, then this is set to expire and would go away, and this deduction would no longer be available. So, this is kind of a key thing, one of the primary expiring provisions that Trump and the Republicans have talked about wanting to extend and make sure stays in place after this year.
Jared, I was just going to make one comment. I think the thing to consider is and I think you'll show this maybe perhaps later on, is the disparity that could be created for owners of pass-through entities versus C corporations if something isn't done to extend this provision, or at least provide some other kind of relief to flow through owners, which I would assume most of our mortgage companies are. So as you said, I think this is a big one that certainly we'll keep our eye on to make sure we know what's happening here with this particular provision.
Yeah, no, that's a great point, Jake, and you're right. When a little bit later here in the presentation, we'll talk about that corporate tax rate, and I'll show an example of how impactful the QBI deduction can be, and as you make a decision about what structure makes the most sense. So with that, let's go ahead and launch poll question number 2. Jamie, if you'll launch that.
Perfect. That is all good to go.
All right. So again, kind of curious as to why you're attending today. Jake and I are hoping it's answer number 4, but we understand if it's just you wanted the CPE. So again, no right or wrong answers. Just make sure you do give us a response so you can get that CPE.
Perfect. And we'll just wait a few more moments here. Just a reminder, get that CPE credit. Just a few more seconds. All right, we are going to go ahead and close that out. Looks like some people are here because you guys are cool, I will say.
Yes. All right, Jake, we get a little love. No, certainly appreciate that.
I wasn't expecting 16%, so we'll take it.
We'll definitely take that, right? So, no, appreciate you being on here, and you know, we understand the CPE is a driving factor for many of you, but hopefully we are presenting some stuff that is also helpful. So with that, let's go ahead and talk about these EBL rules. Jake, you want to go ahead and touch on this one for us?
Yeah, thank you, Jared. Yeah, this is another one of those provisions that that certainly, as noted here, set to expire, not as close in time as some of the other provisions. This one's set to expire at the end of 2028, and that was or occurred because of a suspension to this particular provision during COVID. I think what's important to consider here is that, and as Jared and I were discussing this one isn't necessarily a taxpayer-friendly provision, as what the intent of this does is it sort of limits the amount of trade or business losses that an individual can deduct or take. I guess the nice thing about the provision is those losses aren't necessarily lost or go away, but those suspended losses become, future NOLs to be used at a future time. But as we'll discuss here in a few moments, there are some limitations on how NOLs are used. So again, this particular provision, has created some challenges for individuals who haven't been able to take advantage of or utilize all of the trade or business losses they may have incurred over the last 2 or 3 years as the industry, has been sort of in a downturn. So there may be some folks out there that are hoping and looking forward to this provision potentially expiring at the end of 28 and saying this would be a good thing if it goes away. But I think, as Jared's pointed out, earlier in the presentation, that certainly all of these are going to have to be taken into consideration as they look to balance the budget and figure out, what they can and can't do. And certainly there'll have to be some compromises made to get anything passed. And so, again, this is just one that certainly has impacted some of our mortgage company owners as this limitation has popped up in recent years and created some limitations on the amount of losses they could deduct. So, Jared, I don't know if there's anything you want to add to that, or if we want to move to the next slide.
Yeah, I think you covered it pretty well. Again, I think just highlighting kind of what Jake said is, anything that passes is probably going to have to go through this reconciliation process, and so that's going to require that any sort of tax benefits that they provide are going to have offsets, and this is a pretty decent offset. So I wouldn't be surprised if this one sticks around even past the 2028 timeframe. All right, now let's go ahead and shift gears and talk about some of those TCJA business tax provisions. Jake, why don't you start us off about talking about bonus depreciation and the 179 expense?
Sure, absolutely. So yeah, under the Tax Cuts and Jobs Act, there was certainly some benefit given to business owners as bonus depreciation was reinstated. But certainly that bonus depreciation, they attached a sort of a phase out period to it. And so that's where we are at. As you can see from the slide here, we're now experiencing the phase out portion of this provision. And so for 24, the limitation on bonus depreciation is now at 60%. And then certainly for 25, that will be 40% to the eventual phase out, where bonus depreciation won't even be an option under the current rules. And so, certainly this has been an advantageous provision to a lot of our, mortgage banking companies, as they've been able to immediately deduct, property, plant, equipment, furniture, all the things that sort of are needed to run a business. And so, certainly I imagine this will be a provision that will be looked at. What will be done? Will there be a compromise and they'll do 50% bonus depreciation, which at one time was sort of the rule? Will they go back to 100%? Some offset somewhere else, certainly to be determined, but at least for now, the way the provision is written is this will phase out and we'll lose the opportunity to use bonus depreciation. But as Jared and I discussed earlier, the 179 sort of limit and opportunity for deductions there, that's been a permanent fixture in the code for some time. And so our understanding is this will still be available. So even if bonus depreciation is ultimately phased out or not reinstated in any fashion, companies will still be able to take advantage of using the small business expensing provision under 179, which allows you to immediately expense certain qualifying property up to a certain amount, and that amount gets adjusted each year for inflation. And so as you can see here are the dollar amounts that were available in 24 and would then again would be available in 25. And then certainly there are limitations on even that expensing deduction depending on the amount of qualifying property placed in service. So again, I don't think the loss of bonus depreciation would completely kill the opportunity to immediately expense purchases of this nature, but certainly I think bonus depreciation has been a very nice feature to have and to be able to utilize as property was purchased. So it'll be interesting to see what ultimately happens with bonus depreciation and what they do to either allow this to move forward or to allow it to expire.
Yeah, I think this is one of the more popular provisions, right? That bonus depreciation in particular. So seems likely that one gets extended in some fashion. To your point, is it 100%? Is it something less than that? But seems like there's a lot of traction on trying to get bonus depreciation to continue past the 2026 tax year. The 179, yeah, that one's been kind of all over the place. I mean, I remember earlier in my career, it allowed you to expense $25,000, and now it's $1.2 million, right? So again, that's permanent. When we say permanent, we mean that's what is the law right now, and there's nothing that would make it expire, change, sunset, anything like that. But obviously, Congress can act and change that. So we'll see if they do anything with that 179, or if we're able to still, deduct maybe $1.2 million, $1.3 million of qualifying property. So next one here, Jake, is the business interest expense limitation.
Yeah, and I certainly think, Jared, this is a provision that's I think impacted or does impact most of our mortgage companies. Obviously, interest is a big part of the business, and so certainly I think any limitation on the amount of interest that can be deducted could have a meaningful impact on taxable income, the amount of tax due, tax paid. What's interesting about this provision, as noted, is this is as we'll talk about, this is a permanent provision. So there's nothing on the horizon that's going to allow this provision to expire or allow this limitation to go away. And so what the current rule states is that you're allowed to deduct your business interest expense equal to the amount of your interest income plus 30% of your adjusted taxable income, and that adjusted taxable income has a calculation that goes into it. But outside of that, any business interest expense in addition or above that number is limited and is not a current year deduction. Now, as noted here, that certainly is carried forward to future years, but it's all dependent on the usage of that is all dependent on if you are able to generate or have more interest income plus adjusted taxable income that would allow you to use that carry forward, or would it continue to be sort of moved down the road to be used in a future year. And so, I think this one's going to be interesting. My guess is, Jared, you may feel differently. This one's probably not going to go away. Now, maybe they adjust how you are able to calculate, or how we're able to calculate that adjusted taxable income number to maybe make it more favorable and allow a bigger, percentage of adjusted taxable income to be used. I know at one point during, I think, COVID, there was a couple of years where it was 50% of adjusted taxable income was allowed. So I think there are some things they can do with this provision that may become more taxpayer friendly, but at least as it's currently written, we're limited to that business interest income plus 30% of our adjusted taxable income, and that's the amount of interest expense we can deduct. So I don't, and again, Jerry, maybe you know something I don't, but I'm not anticipating this disappearing or going away as they look to reconcile other areas they can cut. So I would assume this will be in place, and we'll have to figure out what that, or how we work with this moving forward, considering that it's quote unquote a permanent sort of provision.
Yeah, Jay, I think you're right. I don't see this one going away. They may modify it in the ways that you mentioned, adjusting the percentage of adjusted taxable income that qualifies, or how that adjusted taxable income is calculated. But I think this one's probably here to stay, at least in the short term.
Yeah.
All right, let's go ahead and shift gears here to Section 174, which again is that R&E, research and experimentation, capitalization, and then also touch on the R&D tax credit. So Section 174 used to permit, prior to 2022, used to permit taxpayers to immediately expense all research and experimentation expenditures or expenses. As one of those offsets, as we've been talking about in the Tax Cuts and Jobs Act, they introduced a new 174, which required taxpayers to capitalize all research and experimentation expenditures, and then amortize those either over a 5 or 15-year period, depending on if the expenses incurred were domestic or foreign. So domestic you could do over 5 years, foreign over 15. And I think this was one of those provisions that was added to the TCJA back in 2017, didn't kick in until 2022. Everybody thought, okay, Congress is going to do something between now and then, right? That's back in 2017 when the law was introduced. Congress is going to act between now and then, get this fixed. Nobody's going to ever have to capitalize R&E expenses, and then that didn't happen. So there was, a couple of pieces of legislation that were introduced, and one of those pieces of legislation even passed in the House that would again allow companies to expense this stuff, but unfortunately nothing made it fully through the House and Senate and made it to the president's desk for signature. So this is currently still law. This is quote unquote permanent. So unless Congress does something to actually change it, this is what we're stuck with. And companies are going to be required to analyze all of their R&E costs and capitalize them. Now the R&D tax credit that's been around for a long time and is in place and should remain in place for a long time, can help offset some of the unfavorable capitalization that you're now required to do. It's not exactly the same as R&D, but essentially you look for qualified research expenses or QREs. Generally you get a credit for somewhere in the 6 to 10% range of those QREs. And so, and this again is a tax credit as opposed to a deduction. So this is a dollar for dollar reduction of the tax that you owe if you're able to qualify for this credit. So again, with the capitalization rules in place, if you are required to capitalize some costs, it probably is worth looking into whether or not you could also qualify for this R&D credit to sort of help mitigate some of that. I also mentioned here many states also have R&D credits. So if you're in one of those states and you're doing a lot of R&D in that state, that could also provide some additional benefit. So we'll kind of see what happens with this one. I think there's a lot of, people that would like to see us go back to being able to expense these R&E costs. And again, I think there's a lot of bipartisan support for that, just because we want to continue to entice companies to invest in R&E. So, I think most people are anticipating that we'll be able to expense these costs again at some point. We'll just see if it makes it into some legislation here that might happen in 2025. Okay, so with that, let's go ahead and launch poll question number 3. Jamie, if you'll. All right, that's up there. So which of the expiring tax provisions do you think would have the biggest impact on the mortgage industry if it actually expired? So you got the QBI, EBL, bonus depreciation, and the SALT deduction cap. Again, no right or wrong answers, but we do need a response if you want your CPE.
Yes, and we'll just wait a few more moments. We have responses flowing in. All right, we will go ahead and close out this poll. We are closing it now.
All right, let's see what people think about this one.
Looks like the qualified business income QBI deduction.
Yeah, I think that certainly makes sense. That would have a massive impact on mortgage bankers if they no longer were entitled to that 20% deduction. I saw bonus depreciation also got a fair amount of results there, and that also makes sense. You know, that immediate expensing of certain qualified fixed assets has been a huge benefit within the industry. So hopefully Congress will act and both of those will stick around, but we'll kind of see how things play out. All right, so I am going to now touch a little bit on the corporate tax rate. So this is a permanent provision that came out of the Tax Cuts and Jobs Act, meaning, again, unless Congress acts, this is sticking around. It's not set to expire, sunset, revert back to old rates or anything like that. So just to give you a little bit of history, you know, prior to 2017, you had marginal rate brackets for C corporations. The highest one was 38%. Starting in 2018 and now through the present and for the foreseeable future, we have a flat tax rate of 21%. And again, that is permanent. So unless Congress, you know, institutes a new law that changes that rate, we will continue to have a 21% C corp tax rate. But President Trump, as he was campaigning, did propose to reduce that rate down to 20%, so an additional 1% decrease. And he'd also like to see a 15% rate for certain domestic manufacturing activities. So companies that are manufacturing here in the good old United States of America, giving them an additional tax break. So again, we'll see if any of this actually comes to pass, if they're able to find a way to pay for that additional 1% or perhaps 6% decrease in the rate. You know, that remains to be seen, but you know, I don't think anybody anticipates us going back up from the 21% rate that is currently in place. And so I put together a little example here to try and again highlight what, you know, the impact of the corporate C corp rate versus if QBI were to expire, for example, what would that look like versus if you have, you know, QBI in place. So if you look here at the 21% corporate rate columns, you know, if QBI weren't around, the highest individual tax rate is 37%. So if I had $100,000 in taxable income, I'd pay $37,000 in tax. With QBI, that 20% deduction essentially results in a 29.6% tax rate. So if I had that same $100,000 would result in tax of just $29,600 if I qualify for QBI and if QBI is around. And then that C corp rate's 21%. So, you know, 21% of 100,000, that's $21,000. The downside to being a C corp, though, right, is that there's also a second level of tax that's imposed when you actually distribute the remaining earnings out to owners and or the business is sold in some fashion. So if we look at the dividend rate, again, assuming they're qualified dividends, which for the most part should be, and also applying the net investment income tax rate of 3.8%, you would have an additional tax of 23.8% on the remaining earnings. So $100,000 taxable income, $21,000 C corp level tax on that, and then an additional $18,802 in my example here on the remaining $79,000 that eventually will get distributed. So you're looking at a total tax bill of just under $40,000. So you can see in that scenario that, you know, just in a very simple example here, it would make sense to remain a pass-through whether you have QBI or not, right? If we drop down, if the rate drops down to 20%, things get a little bit better. But again, you're still sort of better off being a flow-through entity, whether QBI is around or not. But then at a 15% rate, now you can see if QBI were to disappear, C Corp might actually make more sense. There's some marginal savings there by being a C Corp. So again, looking at it very simply here, just to kind of point that out. The other thing I will say though is that second level, that dividend tax that you're kind of seeing there in the middle, portion of this calculation, that can be deferred, right? There's no requirement to, make those dividends, payments out to owners of C corporations immediately, right? Now you have some rules about, accumulating dividends and things like that you have to be mindful of, but in general, if you're able to defer out those dividend payments and therefore defer out that second level of tax for some period of time, if you look at this more on a time value of money, type concept, right? There are actually scenarios where being a C Corp can be more favorable. Just because, you can save quite a bit of tax with that 21% C Corp rate. Whether QBI is around or not, there's still savings there. And then deferring out that second level of tax, say you defer it out 10, 15 years, right? And you take those additional savings and reinvest them and, get a good rate of return on that reinvestment. You can actually map out scenarios where it would make sense to be a C Corp. So I don't point this out. I don't put this example up here to try and convince everybody to convert from an S Corp or a partnership to a C Corp, but really just more to, food for thought, right? Something to think about, depending on sort of what happens with QBI and what happens with the C Corp rate. Okay, so with that, let's go ahead and shift gears a little bit and talk about these NOL rules, Jake.
Yeah, thanks, Jared. So yeah, obviously, there's a lot of information here on this slide regarding NOL rules as they've had multiple iterations over the last 6 or 7 years. I think what's important to think about, and we'll just focus on sort of where we're at now, is that under the Tax Cuts and Jobs Act, changes were made to how much of an NOL could be utilized. And so currently the rules only allow for 80% of taxable income to be offset by NOLs. Now, the caveat to that is, when were those NOLs generated? And certainly the rule would tell you that any NOL generated, I believe, after any NOL generated prior to January 1st, 2018, you can still use 100% of that, but it has its own set of rules that may or may not have impacted that NOL. And so my guess is most companies don't have any or much NOL from prior to 2018 even available. So then really what it leaves us is, what we have now, what's being currently created. And so the rule really limits us to offset 80% of our taxable income. So sort of the way a simple example would work is if you had $2 million, let's say, of an NOL that you had available to use, and let's say in the current year you generated $1 million of income. Well, under the current rule, you'd only be able to offset up to $800,000 of that $1 million with NOL, and you'd pay tax on the $200,000 because of the limitation of 80% that can be utilized. Now, if you had 10 million of income, you could certainly use the full 2 million because you're still under that 80% threshold of taxable income. So the interesting part is when they made this change back as part of the Tax Cuts and Jobs Act, they eliminated the limitation on how far forward you could carry those NOLs. It used to be a 20-year limitation. Now you can carry them forward indefinitely. They just put that 80% sort of offset limitation on that. And I want to tie this back in just briefly to that excess business losses that we talked about, right? So earlier we said, look, if you have these excess business losses that you're not able to use in any particular year, well, then those convert under the current rules to NOL. And so now the NOL rules would tell you, well, you only get to offset 80% of that, of your income with those NOLs. So there is some, again, some unfavorable sort of taxpayer implications to how excess business losses become NOLs and what the limitations are in use of your NOLs. So, and as a reminder, certainly NOLs are utilized if you're a C corporation at the corporation level. Otherwise, losses are passed through to the individuals. So if you're a partnership or an S corp, any net operating losses get passed through to the individual and are used at the individual level. So as far as my understanding is, this is sort of the, again, we'll use air quotes, this is a permanent provision. I don't know if there's been any discussion about changing this or modifying this, but as Jared's pointed out, when they get into that reconciliation phase, all bets are off, right? And they could certainly look to this provision to say, is there a way, do we make the offset only 60% or 50% because we need to generate more tax revenue to provide other provisions elsewhere? So I think NOLs, again, here the point was just sort of making you aware of what the current rules are and where that limitation currently is at of 80% usage to offset your taxable income. So Jared, anything you want to add to the NOLs?
Yeah, not really. I think you touched on it pretty well there, Jake. I think, again, just stressing this was definitely one of the offsets in the original TCJA, right, in order to get through the reconciliation process back in 2017. And again, with some of the things that they're proposing, some additional tax cuts, benefits, they're going to need offsets again. So seems unlikely that they touch this one much. Again, maybe that offset percentage, does it go from 80 to 70 to 60, you know, something like that. But again, needing to pay for some of the additional benefits they want to provide people, this is probably a decent way to do that. All right. And then, yeah, getting into maybe our final topic here, the state pass-through entity, or what we lovingly refer to as PTE taxes. And Jake and I were talking earlier about how much we love PTE taxes. But so to jump into it a little bit, this was how the state sort of tried to circumvent or get around the SALT cap that was on individual taxpayers, right? So again, Schedule A of your 1040, you could only deduct up to $10,000 of state and local taxes on your personal return. And so you had all these pass-through entities, S corps, partnerships, LLCs in these states, and they were getting, generating large amounts of taxable income that were passing through to owners, and then owners were having to file, state income tax returns in the states in which these businesses operate, and were generating, significant state and local taxes that they couldn't deduct on Schedule A. So the states came in and created these PTE taxes, pass-through entity taxes, that basically said, okay, we'll go ahead and tax the entity. Normally this income just passes through the owners, they pay the tax. We're going to tax the entity instead, and because we're taxing the entity, now it's an entity level tax that is a deduction on, by the entity prior to that income passing through to owners. And so because the deduction is now taken prior to the income passing through to owners, the owners are able to benefit from 100% of the tax, as opposed to being limited to $10,000. So you can see sort of the numbers there. 36 states have now enacted a PTE tax. We've got 3 states that have proposed one. We've got a couple that haven't considered it at all. And then you've got 9 states that don't impose an owner level income tax, so don't need a PTE tax. But so as you can see, most states now that can and need it, or need a PTE tax to kind of get around this SALT cap, have implemented one. What Jake and I were talking about when we said how much we love PTE taxes is that last bullet point. The rules around these vary from state to state, and it makes compliance very complex. So, I think our team has done a pretty good job of getting our arms around how these work in the various states and some of the nuances and challenges that come with filing PTE tax returns, but it's still a complex thing. So I think Jake and I can both say that if they are able to get rid of that SALT cap on Schedule A and these PTE taxes go away, it wouldn't be a bad thing for us. Would certainly make our lives a little bit easier. But if not, these things are probably going to stick around and create an opportunity for owners to benefit from being able to take additional deductions for their state and local taxes.
Jared, the one comment I was just going to make is certainly as we've been learning these PT, tax return rules, it's important to remember that these are different than what maybe a lot of our clients had traditionally been filing, which was the composite tax return, right? Which was that entity level filing filed on behalf of each individual owner to pay that state's tax, but that composite return still required the tax paid to be reported on Schedule A. So it didn't get us around, or doesn't get us around that SALT cap limitation, which again, then to your point, is why these were created. And so to your point, it's just created an extra level of complexity in having to consider where's the benefit, right? And certainly we hope can be simplified in some fashion, but we'll have to wait and see what happens with that SALT cap.
Yeah, no, that's a good point to make that distinction between PTE taxes and composite withholding filings. So with that, let's go ahead and launch our fourth and final poll question. Oh, sorry, let me get this again. Fourth and final poll question. So Jamie, if you'll launch that one. Okay, which permanent, quote unquote, as we've talked about, tax provision would you like to see Congress modify? You got the corporate tax rate, the R&E capitalization, business interest expense limitation, net operating loss deduction. Again, no right or wrong answers, but we do need a response if you want that CPE.
And we will just wait a few moments here. We have some responses coming in.
Perfect.
All right, I'll give you one last final opportunity. Get that CPE in. This is our last poll question of the webinar. We'll go ahead and close it out and share some of those results.
All right, so yeah, corporate tax rate, okay. And then the business expense limitation. Yeah, those certainly make sense. We'll see again, we'll see what happens with that corporate tax rate. President Trump wants to bring that down. I think he's got some support to do that. We'll see if that happens. Unfortunately, again, on those business interest expense limitation rules, it seems like those are probably here to stay. Again, anything's possible, but probably here to stay. Could be modified in some way, give maybe a little additional benefit, but seems like a pretty decent offset to get some of the other benefits and provisions that they're looking to get through to happen. So with that, I am going to skip this last little section here and just kind of get us to some of the key takeaways from our time together here today. So we talked a lot about these expiring provisions. So there's several things that are expiring between this year, 2025, and 2028. We talked about some of the general ones like individual tax rate brackets and personal exemptions and standard deductions and AMT changes, child tax credit. But we sort of highlighted the ones listed here that we think are most relevant to our mortgage banking clients. So we got the QBI deduction that's set to expire at the end of this year. We got those EBL rules, excess business loss limitation rules, set to expire at the end of 28. And bonus depreciation, which has started to phase out and completely phases out at the end of 2026. So again, we thought those were some of the more relevant expiring provisions. We think that some or all of these are going to get extended in some fashion. Certainly a lot of pull in that direction. So we'll have to kind of see what happens here over the next several months as they start working on tax legislation. And then we talked about some of the key permanent, quote unquote, permanent tax provisions and whether or not Congress might act on any of these, including the corporate tax rate, the business interest expense limitation, Section 174, R&E capitalization, as well as the net operating loss rules. So again, it seems like You know, those NOL rules are probably gonna stick around. Maybe they get tweaked a little bit. I think the business interest expense limitation stuff, again, provides an offset. Corporate tax rate, you know, we'll see if they're able to get that down any further, or if they just stick with the 21%. And then again, that R&E capitalization, I think that's the one that we could see a change on, just because I think there's a lot of support, you know, on both sides of the aisle to try and get expensing, you know, being able to expense those costs immediately back into play. So see what happens there. And then we sort of wrapped up our discussion talking about, again, those PTE taxes. So I know this was a lot of information, a lot kind of thrown at you here in the last, you know, 55 minutes or so. But certainly if there are any questions, happy to address those. And, you know, certainly if you have any questions that you think of later on, don't hesitate to reach out to Jake or myself or anyone here on the tax team at Richey May, and we'd be happy to answer those.
All right, it looks like we have one question come through, Jake and Jared, and that's going to be, which expiring tax provision do you think is most likely to get extended, and which one do you think is least likely to get extended?
Yeah, great questions. I think, you know, it's certainly challenging to pinpoint one, but if I had to guess, I would say probably the most likely is the QBI deduction. I think there's a lot of support for that, given sort of where they move C Corp rates, want to you know, keep pass-through entities alive, and if that QBI goes away, there's certainly a lot more, you know, would certainly be a lot more interest in some restructurings into C Corps. So I think that one's probably the one that's most likely to get extended. Least likely, I would say maybe the salt cap. Seems like there's a lot of traction for that one to maybe go away. Just you know, let it expire and allow people to fully deduct their state taxes again. Or it, and now I'm trying to blank on the other one. I was thinking it might be, but
I was going to say, Jared, I was looking at that list and thinking that, you know, if there's one that's least likely to maybe get extended or to get changed, my thought would maybe be bonus depreciation, right? Maybe they just let that phase out completely and use that as one of the offsets to some of these other things they're looking to extend, right? Certainly if QBI is high on the priority list to extend, maybe bonus depreciation becomes less likely, knowing that 179 is available. So again, as I was looking at that list and kind of thinking about what we've talked about today, I could maybe see bonus depreciation being one that's less likely to get fixed or get extended, and then they just let it phase out to zero.
Yeah, no, you're right. I mean, they're certainly looking for offsets all the time, because and that's really what it's going to come down to, right? I mean, in this reconciliation process, you're dealing with lots of people who have lots of conflicting priorities. And so, you know, it's really going to be what benefits do we ultimately want to provide to Americans, and then how do we pay for it, right? And so if there's some massive benefit out there that they want to make sure they get in, and bonus depreciation, letting that expire and not providing bonus depreciation going forward is a way to pay for it, that could certainly happen.
Yeah. No, the last thing I was just going to add, Jared, is I think it'll be interesting to watch over the next, I don't know, what, maybe 6-8 months, just to see sort of what happens, what gets moving in Congress. You know, what does Trump certainly put highest on his priority list to get moving when it comes to benefiting the American people and taxpayers. So I think it's going to be an interesting, like I say, maybe 6 to 8 months to sort of watch to see if any movement happens before the end of 25. And then always is, what's the question is anything they do become retroactive, right? Do they push anything back to make it applicable to 24? So that'll be something to keep an eye on, at least it seems like from my perspective, the next little while.
Yeah, no, great points, Jake. So with that, I see we're running out of time, so we'll go ahead and wrap up. Again, appreciate you all joining us today. Hopefully you found this valuable. Hopefully you also had a little fun, at least with some of those poll questions. Just a reminder that the recording and the slide deck will be sent out here in the next few days. After you log out of the survey, after you log out of the webinar, you should receive a short survey. Appreciate you completing that. It helps us, your feedback helps us for future events. So again, please complete the survey. And with that, we'll go ahead and wrap up. Again, thanks everyone for joining, and have a great rest of your day.
Thank you, everyone.